A major milestone for the Dow, closing above 28,000 for the first time. New records, too, for the S&P and NASDAQ. Big name stocks like United Technologies, Alphabet, Microsoft, all hitting record levels.
Just 4 weeks after that last one, 25,000. It is the fastest 1,000-point gain in history.
Here, new highs on the S&P 500. Mid cap is just below new highs. Small cap, even Europe, just below new highs here. It's a very, very broad rally. And if you want to see how broad it is, just take a look at some of the sectors in new highs.
You know their names, but do you know the game? Everyone knows the Dow, S&P 500, and NASDAQ are the big three stock market indices here in the United States. But why? What are some of the other market indices, and what should everyday investors know about them? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. If you're a regular viewer of the show, you've heard me explain many times that the stock market is ruled more by emotion than by actual economic forces. And the two primary emotions that drive the markets as a whole are the same ones that influence individual investors, and that is fear and greed. Those emotions and their intensity are reflected and measured in the various market indices. But are emotions alone really moving these indices? And just what are these indices exactly anyway? How do they function and interact with other market indices, both here in the US and globally? And are market indices flawed or misleading in certain ways? We're going to be answering those questions today and many others in this show called Understanding Market Indices. And joining me will be Dennis Gartman, the editor and publisher of the Gartman Letter, along with Eddie Ghabour, co-owner of Key Advisors Group and the best-selling author of the book, Common Sense Bull. But first, let's take a very high-level view of stock market indices. Stock market indices around the world are powerful indicators of country-specific economies and the global economy overall as well. As I mentioned, in the United States, the Dow Jones Industrial Average, S&P 500, and the NASDAQ Composite are the three big indices most closely monitored by both the media and investors large and small. However, in addition to these three indices, there are roughly, now get this, 5,000 others in the US equity market, which is actually more than the number of stocks in the US equity market. In other words, there are more strategic combinations of companies than there are companies themselves. Collectively, these indices function in a wide variety of ways and can serve many different purposes. Investment managers and corporations, for example, use indices as benchmarks for performance reporting. Meanwhile, investors of all types use indices to help track the performance of their own investments and to guide their financial decisions. So how exactly does a market index work? Well, there are different ways to calculate index numbers, but the numbers always represent a change from an original base value. This base value represents the average weighted value, weighted in terms of price or market capitalization, of all the stocks that make up the index. For this reason, the index number itself has much less importance than does its percentage change over time. The length of time over which the changes occur, of course, is also an important factor. We'll talk about this later. Now, as most people know, each market index gets calculated on a continuous basis every day during the stock market's open hours to give investors a sense of direction for the market that the index represents. Investors want to know, for example, did the Dow close higher than open today or lower? And by what percentage? Well, it may have closed 1% higher than it opened for the day, but it might still be down 3% for the month. On the other hand, it may still be up 10% for the year. In other words, obsessively following the hour-by-hour, minute-by-minute clicks of an index is generally pointless for most investors, unless perhaps you're a professional day trader. You should also be aware that most stock market indices, including those that supposedly represent the total stock market, only actually mirror a portion of the market itself. That's because each index typically reflects stocks from certain sectors or from certain categories of the market. This is why on any given day when all the major indices are down, you may still see some stocks setting new record highs at the same time. Indices have other limitations as well. For example, the decision as to which stocks to include in a particular index isn't always the right decision. Sometimes stocks get included that shouldn't be, and vice versa, with the process repeated year after year after year. Also, due to the way in which many indices are weighted, large companies can have a disproportionate representation over smaller companies. If so, then one big company can have a bad day and it can throw off the entire index. It's also important to understand that while indices reflect the mood or emotions of investors overall, index movements require actual trades. We've all seen footage of emotional stock traders yelling buy, buy, or sell, sell on the floor of the New York Stock Exchange. Well, it's the actual transactions that are moving market indices. It's what's setting the prices. Although the types of transactions being conducted are obviously being fueled by all that emotion. Lots of buying when greed is the dominant emotion, and lots of selling when fear takes over. Even with their limitations, though, market indices can be very valuable indicators of trends and of changes within investing patterns. And they can provide a good snapshot of market activity, even if they don't really tell the entire story. Ultimately, however, market indices are probably most valuable for providing historical perspective. Studying market performance based on various indices over long periods in the past is one of the best ways to gauge the potential direction of market performance moving forward. And we'll talk more about that coming up in just a bit. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more. And right now, let's welcome our first guest, Dennis Gartman, the editor and publisher of the Gartman Letter. He's also a CNBC contributor, and you've probably seen him in the financial media discussing commodities and the capital markets. He's also chairman of the Akron University Investment Committee, serves on the investment committee at the North Carolina State University, and is a member of the Suffolk Industrial Development Authority. Dennis, thanks so much for joining us today right here on The Income Generation.
Glad to be on. You guys were scraping the bottom of the barrel, and there I was.
Well, heck, we had to wait till you're halfway retired just to get you, for goodness sake. So now that we have you here, we're going to keep you for a few segments. I don't plan to let you go anytime soon. Today, as you know, we're talking about stock market indices. And as you probably are aware, most average investors don't really understand the different indices, why they're different, how they're weighted differently. But I'd like to ask you from a layman's perspective, if for your average investor out there, your average member of the income generation, what do you think people need to know about indices? To what extent do you tell them to follow indices as a base of comparison of her performance? And which extent do you say really, be careful, don't overdo it?
Well, I guess the most important thing is the first one that everybody hears is the Dow, which is only 30 stocks. And it's by that definition, it's awfully finite and it's awfully small. It doesn't reflect very well on what's going on as far as high tech is concerned. The next one that everybody is aware of or should be aware of is the S&P. It's obviously 500 stocks, far broader in orientation, far more representative of the economy in general. The next one that everybody should pay attention to is the NASDAQ, which is even broader than is the S&P, and probably far more representative of the of high tech, for lack of a better term. And back at the turn of the century, owning the NASDAQ, owning the NASDAQ, being short of the S&P was the trade of the decade for a while. And finally, there's the Russell, which is a much even broader. It's 2,000 stocks, and probably most representative of all, but the least liquid and the one that the public is least aware of. Then there's always the DAX index in Germany, the Nikkei in Japan, the CAC 40 in France, So each of the countries has their own indices, but the ones that we're probably most interested in are the Dow, which is narrow, the S&P, which is wider, the NASDAQ, which is wider still, and the Russell, which is the widest of all.
So in the 1 minute we have left in this particular segment, tell our viewers, if you will, what do you think some of the limitations are here? Because people get so fixated comparing performance in their portfolios to an index. So how do you keep them from getting overly fixated on this type of thing?
I wish I could answer that question as well as I could, because as the chairman of the University of Akron's endowment and now 15 years on NC State's endowment, we fight all the time over which index we're going to be indexed to. And in the great scheme of things, you're probably going to get angry at me for this, but the difference between the Dow and the difference between the S&P and the difference between the NASDAQ over any broad period of time is really going to be relatively minimal, to be bluntly honest. I think for the retail clientele, they really shouldn't get too, they really shouldn't delve too deeply into the differences between one index and another. Just again, they represent broader indices, broader representations of the economy. But whether in a bull market, they're all going up together. In a bear market, they're all going down.
Yeah, in general, they do tend to track each other a lot over the long run. So, Dennis, if you could stay with us, please. We need to take a quick commercial break. You stay with us, too. We'll be back here in a moment with more on the income generation.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks, but yet you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement. The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementincomeStore.com.
As you probably already know, the three most widely followed indices here in the United States are the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. So let's take a moment to take a closer look at each of these indices and the market sectors that they capture. The Dow Jones Industrial Average is the oldest and best known index. It is also the most widely quoted index and is often considered, whether rightly or wrongly, the barometer of the overall market. The Dow, though, is actually far from that because it currently holds only 30 stocks. But those 30 stocks represent some of the largest and most influential companies here in the United States. It is also the only major index that is price-weighted, which means that if a stock's price changes by $1, it has the same effect on the index regardless of the percentage change for the stock. In other words, a dollar change for a $30 stock has the same effect as a $1 change for a $60 stock. Now, Dow stocks represent about a quarter of the value of the total market, so its movements up and down can be a telling measurement of investor confidence across the board. But just be aware that it does not represent investor sentiment around any small or mid-sized companies. The Standard & Poor's, or S&P 500, is the index most frequently used by financial professionals as a representation of the total market. It includes 500 of the most widely traded stocks, but also tends to lean toward larger companies. The S&P covers about 70% of the market's total value, so in that sense, yes, it represents the true market more so than the Dow. Like most other major market indices, except the Dow, the S&P 500 is a market cap weighted index. Therefore, every stock in the index is represented in proportion to its total market capitalization. In other words, if the total market value of all 500 companies in the S&P 500 drops by 10%, then the value of the index also drops by 10%. Weighting by market cap, though, gives more importance to larger companies, so that changes in Microsoft stock, for example, will have a greater impact than almost any other stock in the index. Yet, even though the S&P 500 is weighted toward larger companies, it can still provide a more accurate gauge of the broader market than the Dow, simply because it includes so many more companies. Now, that being said, it's also true that all the major indices tend to move in sync to a certain degree, and one rarely takes a major jump or drop without the others doing likewise. Which brings us to the last of the big three here in the US, the NASDAQ stock market composite. It includes all of the stocks listed in the NASDAQ market. So in terms of number of holdings, it's actually bigger than the Dow and the S&P 500 combined. Although it is broad in its coverage, the NASDAQ is heavily weighted toward technology stocks. In fact, nearly half the companies represented in the index are technology companies. Now, like the S&P, the NASDAQ is a market cap weighted index. And stocks of very large companies like Apple and Microsoft strongly influence the index. Their influence, along with the number of small speculative companies in the NASDAQ, tend to make the NASDAQ more volatile than either the Dow or the S&P 500. Ultimately, even though the NASDAQ wasn't designed to represent the overall market, it does provide good insight into the optimism or pessimism of technology investors. And obviously that has become an increasingly important economic factor over the last several decades. Now, in addition to the big three indices, there are some 5,000 other indices that measure larger or smaller sections of the market. And mutual fund investors can find a number of funds that track almost any index that they want to track. And that being said, the big three indices are really all that most everyday investors need to get an indication of in terms of determining how their stock and mutual fund investments are doing during their growth and accumulation stages of retirement planning. But when it comes to using market indices as tools for making financial decisions after the age of 50, well, at that point, most people benefit greatly from enlisting the help of a specialist with a more in-depth understanding of market indices and the financial markets overall. And we'll talk about that more coming up in just a bit. Also coming up, we'll take a closer look at where the market indices stand today, what's driving them, and how they compare to other indices around the globe.
Would you take your grandchildren out for ice cream and try to pay for it using your stock certificates? No, that would be ridiculous. Instead, you would use your income. So why then do so many retirees make one of the biggest financial mistakes, dipping into their savings instead of relying on income during retirement? The good news? It's completely avoidable. To learn more, visit theretirementincomestore.com.
And right now, let's welcome back Dennis Gartman, editor and publisher of the Gartman Letter. Dennis, thanks for sticking around.
Oh, honored to be asked. The fact that you put up with me for 4 minutes already is astonishing.
Hey, so were you surprised about the market's performance last year? I mean, particularly toward the last couple months of the year, or not really?
Yes, really. I was astonished by the market's performance last year. You have to remember that in October, November, December of 2018, things went into the dinger so quickly, and it had the appearance. I mean, the stock market is a presager of what goes on in the economy, and it looked like we were heading for a recession. The Fed was beginning the process of tightening monetary policy, and all of a sudden, I mean, things really looked quite ill. The fact that we turned around as quickly as we did on a dime caught me off guard. I think it caught every professional off guard. and most of the pros underperformed the stock market in general. It was a stunning, surprising, shocking, and absolutely amazing performance. Are we going to see that again? Probably not in my lifetime.
Yeah, and all in spite of a flat yield curve, right? We had good flat yield curve for at least 6 weeks during the summertime.
In spite of an inverted yield curve for a couple of days in the middle of the summertime. I mean, that really got everybody very disconcerted.
And it seemed like the Fed jumps in, they start buying back Treasury bills on the short end of the curve to right side the yield curve and pretend like it never happened. And it seemed like the markets bought it. So I guess the question then is, how about this year? How about 2020? Do you think that with it being an election year, with this concept of not fighting the Fed and the Fed seeming to be more accommodative now, do you think that we could squeeze one more good year out of it? Or, what are you telling people?
Let's understand that it's not just the Fed that's becoming far more accommodative. The Bank of England is becoming more accommodative. The Bank of China is clearly becoming more accommodative. They've actually cut reserve requirements, which is, I've always said, there's nothing more potent in the equities market and nothing more potent in the interest rate market than a cut in the reserve requirements. It's the 2x4 to the mule of the economy, and the Bank of China has done that. The Bank of Japan is becoming monetarily easier. So this is something that's going on around the world, and as long as the monetary authorities are becoming expansionary in their policies, you don't fight the Fed, you don't fight the Bank of China, you don't fight the Bank of Japan, you don't fight the Bank of England. It is amazing to me that stock prices are as high as they are. By any valuation, they are overvalued, but as long as the monetary authorities are expanding, you have to say the bull market will continue. Shocking, but true.
So if you had to make a guess as to when perhaps we slip into the next recession or bear market cycle, do you think perhaps 2021 after the election? Well, what would your best educated guess be? And I know it's just that, a guess.
We are so long overdue for a recession of some consequence. And the next recession that we get will not be anything approaching what we went through in 2007, 8, and 9, because we don't have the bubble other than the equities market. And the monetary authorities will be the very first to come back and become, again, more expansionary. But when will a recession hit? I don't think there's going to be one in 2020. And you're probably right. It'll probably be after the presidential election and on into 2021 before there's any sign of weakness. The only caveat I will give to that is that my favorite index as far as the economy is concerned is the conference board's leaders, and the leaders have been down now 3 months in a row, and you have to pay attention to that fact. Doesn't mean they can't turn higher, doesn't mean that can't be ineffective, and we've had non-recessionary periods when the leading indicators have been down for 3 months in a row previously, but the fact that they've been down for 3 months in a row is to me quite bothersome.
10 seconds. Next recession, do you think we'll see negative interest rates here in the U.S.?
I'm afraid we shall. It's frightening. I cannot believe that we're already there in Europe as we are. But I'm afraid that we're going to probably take it to negative interest rates. Shocking though it might seem, the rest of the world has gone that way. We probably shall follow.
I wouldn't be surprised. Dennis, we need to take one more commercial break. We'll be back in a minute. And you don't go anywhere. You stay with us. We'll be back here in a moment on the income generation. Now, if you've been following the big three U.S. market indices recently, then you certainly don't need me to tell you that they've been on a heck of a tear since November. A year-end rally in 2019 helped the S&P 500 score its best year since 2013, and all three indices finished the year with strong gains. That great finish looked even better considering that 2018 marked Wall Street's worst year in a decade. Initially, the rally continued into 2020. Financial markets in the U.S. and much of the world were closed on New Year's Day, of course, but on the first day of trading, all three market indices surged. The Dow finished up a whopping 330 points, more than 1%, while the S&P climbed 0.8%, and the Nasdaq ended 1.3% higher. So what prompted the optimism that led to all the buying on the first new trading day of the year? Well, it was attributed mainly to an announcement by China's central bank that it was launching a new artificial stimulus. The plan calls for reducing the portion of deposits its commercial banks are required to set aside as reserves by 0.5%, which is expected to inject more than 800 billion won, or almost $115 billion into China's financial system. Following that announcement, China's main market indices, the Shanghai Composite and the Hang Seng Index, each jumped by 1.2%. That optimism spilled over into the US and European markets, demonstrating once again how the modern global economy is more interconnected than ever before, and how markets everywhere have become addicted to artificial stimulus in the years since the financial crisis. And as you know, China's had a major influence on the global financial markets since early 2018, when the president first announced new trade tariffs, a move that ultimately led to a full-fledged trade war between the world's two largest economies. Thanks largely to that trade war, the stock market remained in a nervous holding pattern for all of 2018 and for a good portion of last year, as reflected by all the major market indices. But as recently as early October, the S&P was only 80 points higher than it had been in January of 2018. And the Dow was actually 600 points lower than it had been in January of 2018. As I mentioned earlier, the amount of time between the percentage change for any given index is an important factor, particularly for retirees and near retirees who must plan for up to 30 years of reliable income. The reality is that most of the stock market's latest gains have occurred only in the last few months and have largely been a result of big investors focusing on what really is a handful of hopeful and/or artificial economic developments while ignoring many other factors. For example, the rally began in late October following an announcement that the US and China might reach a deal to de-escalate the trade war by year's end. The rally continued in November and December as that process moved forward and as interest rates stabilized, and it initially continued into 2020. Meanwhile, Wall Street has been ignoring numerous recessionary red flags and a warning from the International Monetary Fund that the global economy is already in what they called a synchronized slowdown. Instead, big investors are trying to stay focused on the positive things like the potential trade deal and still the possibility of more artificial stimulus. As we pointed out previously, this latest Wall Street rally has all the earmarks of what I call a classic blow-off top, which is simply a period of relatively steady market growth that occurs in spite of mixed economic news and recessionary warning signs, and is sometimes followed by a sustained steep drop. How long might this one last before the market indices start to more accurately reflect economic realities and start to make fundamental sense again? We'll be talking about that more coming up in just a bit. Now let's welcome back for one final segment, Dennis Gartman, editor and publisher of the Gartman Letter. Dennis, I have to tell you, it was with much sadness that I heard the news about you ending the Gartman Letter as of the end of last year. Tell us, what brought you to do that and what stands in your future for our good friend, Mr. Gartman?
Well, after 35 years of getting up at 1 o'clock in the morning to knock out 5, 6, 7, 8, 9 pages every day that I hope was insightful, that had a good geopolitical overview, that had a good overview of what was going on with the monetary authorities, that had a good overview of energy, that had a good overview of the grain markets. I always cast myself as the liberal arts major of the capital markets. I knew enough about each one to speak to each individual area. And after 35 years, quite honestly, my hands were getting a little tired. My mind was getting a little tired. I was getting a little tired. And in 35 years, I missed 3 days. One from my celebrating my parents' 50th wedding anniversary, one because of a hurricane, and one because of a kidney stone. Don't get a kidney stone. Avoid them if you can.
I will take that advice if I have anything to do with it, for sure. So what's your next chapter? I mean, I'm sure you're not the person who goes from 1 o'clock in the morning every day for 35 years into full retirement. What's next?
I'm going to start writing a bi-weekly just to keep my fingers in the pie. I'm going to do a couple podcasts, 1 or 2 a week, just to keep my fingers in the pie. I'm trading from my own account, so I'm obviously in the market every single day. I'm watching the markets probably even more efficiently and effectively than I was before. So no, full retirement is not on the horizon. I'm still up and kicking, so I'm probably going to be around for a while longer. It's just that I did grow weary of getting up at 1 o'clock in the morning and only getting 3 hours sleep a night. That grew wearisome.
Oh, I can only imagine. And hey, even a kidney stone only kept you down for a day. So, so what do you hope in your heart of hearts that your readers have gotten over the years from your newsletter?
A couple of things. One, the very simplest rule of trading and investing is a rule that is good in life. Do more of the things that are working and less of the things that are not. If you buy a stock at 10 and it goes to 15, buy more. The market's telling you that you're right. If it goes to 5, don't get out, maybe. I would say get out, but don't do more of that. Don't average down. That's the most important thing. So do more of that which is working and do less of that which is not. That's the most important thing I think I've gotten across. 2, some of the economic indicators, pay no attention to the trade deficit. It is not terribly important. In fact, as the trade deficit has gotten larger, the United States has gotten stronger. And I've been told for years and years that we can't have the trade deficit get wider. It'll be detrimental to the economy. It's just not true. And 2, markets can go farther than anybody ever believes possible. As the great Lord Keynes once said, the market can remain illogical far longer than you or I can remain solvent. My corollary to that is that the market will return to rationality the moment you have been rendered insolvent.
Well, and frankly, the market staying irrational longer than we could have expected is part of what's happening right now, because this market blow-off, as I call it, as of the last few months, has gone on a lot longer than either you or I have expected. So in 45 seconds we have left in this segment, as you know, our income generation show is mostly for those who are retired or within 10 years of retirement. What are the best words of wisdom you can give to those folks watching you today?
It's a bull market in stocks. It will probably always be a bull market in stocks here in the United States. Buy good companies that have long-standing dividends. If you're retired, that's probably the best instance of all. And take a look at some of the ETFs that have dividends that pay monthly that pay dividends on a monthly basis. There are I shouldn't say hundreds, but there are certainly dozens of them out there that yield 6, 7, 8, 9, 10%, and people are not paying enough attention to them and should.
And in today's environment, you can get 4% dividend on blue chip value-based stocks without even being a bottom feeder. So I think that's really good advice. And Dennis, congratulations on semi-retirement, and thanks so much for being on the show.
Thanks for having me on. It's been an honor to be here. Good luck, and as I always sign off, good luck and good trading.
All right, it's been great having you, my friend. You stay with us too. We have more coming up right here on the Income Generation in just a moment.
behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
If you saw my recent 2020 market forecast show, you'll recall I predicted that the current blow-off top that the stock market is experiencing could possibly last for the entire coming year or even longer before reality finally hits. However, I also made some other important points about the markets that bear repeating. One is that this blow-off top clearly illustrates why the bond market is often said to be smarter than the stock market. A reliable indicator or index for the bond market is the yield on the 10-year Treasury rate, which stabilized this year between 1.5% and 2%, where I believe it will hold for some time to come. Interest rates in that range certainly do not reflect the kind of economic growth needed to justify a soaring stock market. In other words, the two markets disagree. Why? Because the bond market's guided by logic, where the stock market's driven by emotion and animal spirits. The bond market's paying attention to the recessionary red flags that the stock market seems to be ignoring. The bond market remembers that the U.S. yield curve was inverted for part of 2019, and that an inverted yield curve is a historically reliable warning sign of recession. Although the main reason I forecast the possibility of more new market highs for all three major indices in 2020 is actually the Federal Reserve, because it has sent a clear signal that it will do just about everything in its power to keep the stock market artificially inflated and to delay the next major correction. They sent this signal with their launch of a new round of quantitative easing, which was triggered in response to a liquidity crisis that occurred in the banking system last September. In addition to instantly pumping money into the repo market, in October, the Fed began buying up short-term treasuries at $60 billion a month. They'll continue doing so into the second quarter of this year in an effort to manipulate the short end of the yield curve. As for how long that might extend this blow-off top, still remains to be seen. But again, I believe that could possibly carry on for months to come, possibly as far as through the coming year, particularly with China now launching its own artificial stimulus. On the other hand, in addition to all the recessionary warning signs out there, there are also plenty of unstable situations in the geopolitical realm that could trigger the next big sell-off, including an impeachment process and now the possible threat of war with Iran. So with all this in mind, there's two important points for investors in or nearing retirement to consider. One is that by looking at any stock market index going back to 2000, I believe that a third major drop of our current long-term secular bear market cycle has not yet occurred. I believe the Fed, with all its artificial tinkering, has managed to delay it at least up till now. The other is that I believe history indicates this next major correction could range between 40 and 70%. So even if the S&P, Dow, and NASDAQ all add another 10 or 20% or so during this blow-off top period, you have to ask yourself, is a small additional gain really worth the risk of a major loss when you're this close to retirement? Now it's time to welcome our next guest, and my very good friend Eddie Ghabour, co-owner of Key Advisors Group in Lewis, Delaware. Eddie is a regular on Fox Business and across the financial media. He's also, of course, one of my very good friends and a great friend of the income generation. In addition to that, he's the best-selling author of the book, Common Sense Bull. Eddie, thanks so much for being here with us on the show today.
It's my pleasure. Thank you for having me.
Hey, so as you heard, we're talking today about stock market indices. And of course, you and I being in the business, we tend to look at the S&P 500 more than anything because it's so broad. But what do you tell your clients in terms of what are the benefits of using indices or they're watching indices from time to time versus maybe what are some of the drawbacks?
So one of the toughest things is educating folks on really what they should mirror or compare their portfolio to. As you well know, most people just compare their portfolio to the S&P 500. And for our client base, if we have 100% correlation to the S&P 500, then I should be fired doing what I'm doing for a living because their money's not all in the S&P 500. A properly diversified portfolio, in our opinion, should have weightings in small caps, international, domestic bonds. And if you want to truly measure it, you need to weight that with each one of those indexes. So looking at the S&P is a great gauge of what the overall market is, but it should not be a gauge of what your portfolio should be returning, in our personal opinion.
Yeah, it's funny. I've seen people do that have a 50-50 portfolio between stocks and bonds, but yet they look at it and compare it to the S&P 500, and only half of it, best case, only half of it should be compared to that. So in 30 seconds or less, where do you tell them indices can be beneficial?
You know, where the indices are beneficial, I think, is it gives you a gauge on what corporate America is doing in regards to profitability and what the overall stance is from investors. I mean, to me, that's about the value it brings, because unless you're going to dissect every holding inside that portfolio, which, as you and I know, most people aren't going to do, it's just a good pulse on where we are in the stock market.
Or buying opportunities, you get a major dip, that type of thing too. So, hey, stay with us, please, Eddie. We need to take a quick commercial break, and you stay with us also. We'll be back here with more coming up in just a moment on the income generation. And welcome back. We're talking with our good friend Eddie Ghabour, co-owner of Key Advisors Group in Lewis, Delaware, and also best-selling author of the book, Common Sense Bull. Eddie, thanks so much for sticking around.
Absolutely.
Now, I know because you were on our show just a couple weeks ago talking about the markets, your projections for next year. I know you think the market's a little bit overblown right now, and you have some concerns about it over the next 12 months or so. Do you have clients watch indices for potential buying opportunities? I'm just curious, and I do that in my practice. I say, gosh, if you see the market get below a certain level, you might want to give us a call. It might be an opportunity to get a little more aggressive, assuming, of course, they're at the right stage in their lives where they could take more risk.
Yeah, absolutely. I mean, for for many of our clients last year, as the market continued to hit new highs, we raised some cash for clients with the idea that when we did see some type of correction, because you will normally see at least one or two corrections per year, we would try to find a better entry point. Because right now the market has had one heck of a run. It has surpassed all expectations. And it's my personal opinion that we are due for some type of short-term pullback that will be a good opportunity for the person with the right risk tolerance to take advantage of that.
Yeah, and what we've seen over the last couple of weeks is interesting with this irrational exuberance, so to speak, going on in the markets. Just recently, we saw the whole thing going on with Iran and so on. The market seemed to just shrug that off. They just wiped it off their shoulders, and markets are going up again. Did it surprise you how resilient the markets were even just this past week with what's going on geopolitically?
Absolutely. I mean, it's almost like the market right now just doesn't want to go down. It's probably one of the most resilient markets that most people will see in their lifetime. But that's also a warning sign, because bad news should be bad news for the market. And when the fundamentals don't match what the return is, that's a red flag. And so that's another reason why we feel that right now, I think the market's still going to do well this year, but I think right now we are due for some type of pullback, and I hope people are prepared for it.
Yeah, and it might do well, but if it doesn't make fundamental sense, if ultimately it's pure speculation, most of your clients, as most of my clients, don't really want to speculate. They don't want to participate in that. So 45 seconds left in the segment. Tell our income generation members your best words of wisdom for 2020.
For 2020, after a record year last year in regards to what their portfolios have probably done, they need to take some caution and don't get caught up in the exuberance of the market hitting new highs and getting outside of their normal risk tolerance. That's a big, big concern for us. So be defensive heading into 2020 and make sure you're well aware of the risk you're taking in your portfolio.
And most important, don't get greedy.
That's exactly right.
Yeah, good advice. Good advice from the big state of Delaware. Eddie, thanks so much for being on the show. I really appreciate that.
It's my pleasure. Thank you, David.
All right, you stay with us too. We'll be back here with more coming up in just a moment, right here on The Income Generation. I'd like to thank both of our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Before we go, I'd like to make one more point about stock market indices that is especially important for you nearing retirement. As I noted earlier, the major indices can be a helpful way to keep track of your stock and mutual fund-based investments during the growth and accumulation stage of retirement planning. That means typically your 30s and 40s when you have a 401k, or similar investments focused on growing your nest egg for the future. However, once the future arrives and you're within about 10 years or so of retirement, then it's time to shift from the growth and accumulation stage of financial planning to the protection and income stage. And once you've made that shift, the stock market indices should become far less important in your life. In part because these indices measure only one component of total return, and that is growth. Growth is actually defined as capital appreciation. Although remember that total return is a sum of both growth and income, which comes in the form of interest and dividends. Once you've shifted your focus from growth to income, the ups and downs of the Dow, S&P, and NASDAQ, and all the other stock market indices become far less relevant to your personal finances. That's because in making that shift, you've created a plan designed to protect your principal from the risks of spend down and the risks of major market losses, and also to generate reliable income at competitive rates regardless of market conditions. If you haven't yet made that all-important shift yourself, then now might just be the perfect time. With the market still riding high, you can go out on top and protect your money before the next major correction kicks in. It all starts with finding an advisor in your area who specializes in income-based financial strategies, which is now easier than ever before through my retirement income store. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.